26 April 2023, Wednesday, guys, MAO with Kel once again. Now, warning, we are probably 4 months away from the US, in fact, global recession. Now, I know that I've been saying this for some time, and I'm going to give you more details today, because if you don't pay attention to this detail, probably you're going to get yourself hurt. All right, let's go. All right, disclaimer apply as usual, and thank you, Ames, for the kind sponsorship. Now, before we go into that, right, guys, do understand this. On the 3rd of May, we are going for this, okay? The tomahawk cake. All right, it's special. The specialty is on beef, barbecue beef. So for people who love beef, all right, it's time for you to watch my video, leave a comment, and this coming Saturday, we will do the draw, all right? Spin the wheel, lunch with Kel, all right? 4 packs will be invited for next Wednesday lunch, okay? So do yourself a favor, if you want to go for it and enjoy this, quickly now, leave me a comment in the comment box. All right. So for those people who have commented, all right, I've given you the thumbs up and the love button. That means that you have now stand a chance. Now you can send as many as you want. Of course, it's related to like 1 posting per video. All right. But of course, there's so many videos, right? The last few days, just post on them. I'm pretty sure you may stand a higher chance of winning. Okay, guys, thank you once again. This is so incredible. More than 180 people have signed up for my coming preview. All right, this is something that is wow. Okay, I think probably you guys are going to try out my latest TCS system. I understand that. And the thing is this, many of you are pretty concerned right now. 122 of you guys are concerned that we are going to head towards a global recession, and I can tell you this, you're absolutely spot on. All right, after this video, you'll definitely tell your spouse that, you know what, let's get ourselves ready for this. Okay, so first of all, you will be able to use my system. My system is incredible. As long as the system says today is a buy signal, you can see from there itself, when the KSI is green means the boys are buying, and my KCX is blank or black, you can just go into buy because the buy is yellow. Simple. If you've not watched my 3 minutes to understand TCS, quickly watch it right now. You understand it better. So for today, right now, 26th of April, we've been calling for buy. Yes, we don't call only for sell, we also call for buy. And we've been buying Hang Seng this morning. We bought in the morning right here. Let me just show it to you, because it was a yellow bar, followed by KSI green and KCX is blank. We go for buy, and we held a position until here for some profit. And then for those who are a bit more adventurous guys, they will try to buy here again, because everything's in line. Right, everything's in line, yellow bar, KSI green, no blue bars, so they can buy here. I didn't buy, but some of my students bought it. All right, they are more adventurous than me. So guys, very simple technology here. You just have to follow through. All right, so let's recap what happened last night. Wow, the Dow Jones lost 344 points. The NASDAQ down by 244, and the S&P down by 65 points. That's a lot, huh? Now, we did call for S&P to come off to 4054 yesterday, and we're just about 20 points away. So spot on, right? Pretty good. So we have Microsoft, Google all coming off ahead of their earnings. And of course, Amazon down by 3% of more concern, and Tesla down by 1.16. But more important than the banks like JP Morgan, Bank of America, Wells Fargo, Morgan Stanley, all down between 2 to 3%. That is something that I'm pretty concerned of. And if you ask me right now, right, I can tell you this is not going to end so soon. Yeah. All right. You can see that it was the First Republic. Earnings was really bad. Lost of $100 billion of deposit. That's why the share price plunged 48% overnight. And that basically sparked the SPDR S&P Regional Banking ETF and SPDR S&P Bank ETF, lost between 4 to 3%. Yeah. And of course, we have Western Alliance, Bangkok, which I told you guys, Bangkok, right? Tell you guys to be careful of this counter. I told you this counter will likely be going down yesterday, and truth be told, it really happened. And of course, right now, more concern right now is that even though the result came out, Microsoft and Alphabet, but we don't, and it's slightly better than expected, but apparently it's not having any reaction on the future side. So that means that, right, the market has already priced in all this, and the market is trying to find a corner to basically take profit from here. So to me now, be careful, guys. If the big guns are not able to make things better, then be careful, because if any negative news comes out, right, it may actually affect the market. So for today, we have Boeing coming up before the market, ADP 2, and of course, after market will be Meta and Roku, right? So let's just look for it. Now, one thing is that you must understand now the Treasury's bears are reloading their shorts again. Now, when you actually short the Treasury, it's because you expect the yield to go higher. And we thought that everybody thinks that the yield is going to stop right now. Well, apparently the hedge funds are not really doing that. So let's watch this from Bloomberg and see what you can learn from there. Let's go.
So Valerie, what do we know about shorting treasuries?
Look, there's two things notable about the CFTC positioning data that came out on Friday. One of them being the most net shorts on that 10-year bond on record. But the second one being is that their shorts were across the curve as well. 2-year futures, 5-year futures, 10-year futures, and 30-year futures all had net short positioning from the hedge fund community. It could suggest that we could be very ripe for a ferocious rally if yields don't continue to creep higher. But it's also prudent to ask, why possibly are they positioning short? Well, let's look at the calendar. What we have this week, we have US GDP, the first advanced reading of the first quarter on Thursday, followed by the Fed's favorite measure of inflation, the PCE metric on Friday. Perhaps the hedge fund community is positioning for a very upside reading on GDP and perhaps a hot PCE number, posing a big question about this Fed pause in May, leading yields to run higher. But I want to caveat that with one thing, Matt, and we need to remember that that hedge funds use Treasury futures not just for directional plays, but also for RV trading as well. We know that vol has been declining significantly in the last 6 months. Perhaps this is just suggesting there is a build of a major RV trade in the 10-year part of the curve.
All right, so we do know that this coming week, we will have a lot of data coming out Thursday and Friday. Now, what he's trying to say is pretty simple, okay? If the GDP number this Thursday come out better than expected, wow, that means the economy is not coming down. And that will not help inflation. It's a bit of a paradox here, but that is what you're trying to say. And if the PCE data is going to shoot up again, it means that the inflation numbers are there, then that means that the Federal Reserve will have a lot of room to basically put more interest rate up on the market. All right. So all these tells me that we just have to be very careful because the market now is definitely not in the level to accept more rate hikes. But if this is going to continue because of inflation, because there's so much room to go, then I think the stock market will get hit. Yeah. So that is reason why we can see right now that despite the ongoing rumors about the Federal Reserve cutting interest rate and stuff like that, the bond market itself ain't really reacting much. So this again speaks volume for itself. Yeah. Now, one thing to note is that you must understand now the US interest rate could really hit 5.5 to even 6%. Now, of course, we all know that over the last probably 40 years, okay, the average Fed fund rate is about 2.5%. You look at across the board, about 2.5, yeah, talking about the high and low side. And now we are doing about 5. So of course we are like double of the normal, but you must understand that we have inflation that is way, way, way above. So that is a concerning factor. And of course, right now, even though that we have interest rate going up, and that probably has pushed the prices for home prices coming down a little bit, but it's still very far away from where the low was, okay? So to me, it's all right. This is not enough. You probably need a little bit more rate hikes to basically bring down the home prices. And of course, the problem is this right now, the home prices coming down a little bit, but the income growth is also coming down at the same time. Now look at the houses in this US, it's not cheap at all. We talked about last time, it's like only like $500,000 to $800,000 worth. Now it's 1.1, 1.2. It's really going up fast. In fact, I was just having a little conversation with my cousin in US, and he's telling me this, the price there is getting ridiculous and it's getting hot. And in fact, there's a lot of thefts going on. In fact, some of the power supermarket like Walmart has to close down because of all these thefts. Okay, this is really crazy. And I think I covered this before. So if if the income growth is not actually increasing or in fact declining, and with the home price coming down at the same time, mortgage rate is going to be a problem. Because what happened is that the banks will come back to you and say, look, the price is coming down. That means that whatever you bought at high, you have to revalue it. You need to look at it, refinance again. So all this is going to be like a repeat of what happened in 2008. Yeah. So one thing is that we can see very clearly now the unemployment levels, the permanent job losses, losers are really climbing up. Look at it, it's really climbing up. All right, guys, this is no joking matter because we have seen it before in year 2001 when this happened. Well, once it crossed the 10, the index 10, where we are almost there right now, we're 10 actually. Right, you can see over here itself, guys, we're near the 10 level, we can see recession coming in. And of course, back in 2008 itself, right, we come about 10 to 15, we saw recession. And of course, this happened again back in 2020 during the pandemic time. So you look at it in history, I mean, seriously, guys, we're just a couple of months away from recession. If this is something that is clear for you, I think you should know what am I trying to say. And of course, with that happening, you can see right now that if you look at it closer, you can see that this is really, really happening. We are not too far away. Usually when the uptick comes in, within about next 3 to 4 months, we're going to get that movement. And that's why you can see right now from this chart shows everything. If you look at the AAA bonds versus the Fed fund rate, you can see that almost every time when the number goes below the zero marker, you will see that recession is actually coming in. So now we are back down to this point here. Hence, therefore, I am pretty confident that within the next 3 to 4 months, we could actually see recession coming in. That means that players will start to notice that, you know what, let's get out of the market. So 3 to 4 months time, I believe that US will enter recession. Now, of course, you may say that, Kel, but the GDP numbers, if you say it's going to be good, then how could it be a recession? Well, recession doesn't mean that you really must be based on 2 consecutive months of GDP numbers going down. It could be a sudden impact. It could be a sudden unemployment numbers surging up. There could be a lot of possible, right? So my view is this is going to happen pretty soon, because now we can look at the real GDP versus the leading economic indicator, the LEI. Both of them are actually trending downwards. And in history, whenever the both of them trends downwards, recession is always on the cards. So all this information tells me that by now till August or September, we will see a US recession. And of course, what will happen to the stock market is pretty simple. This is the initial jobless claims. Now you can see it's actually moving up. And of course, in the past history, when you move up, this is where you get a recession, right? The orange area is the distance of the recession. So you can see back then in 2008, when the initial claims goes up, all right? This is the duration of the recession. And look at the stock market. This stock market was in the cyan. You can see the stock market actually comes off. So it happens again back here itself. When the initial claims goes up, the stock market pulls back, and again, it happened again. All right. So all this information tells you that you need to be careful. Now, it's not that you shouldn't buy stocks, but I think that you can wait for another 10 to 15% drop. Then that will be a good time to buy some stocks. All right. I'm still a big advocate to buy stocks in the later part of the year when things stabilize, or at least the selling is over. Then we can try to buy and keep for long term. What do you think, guys? Leave me in the comment box. Let me know what you feel right now about my view. But more important is look at this chart, guys. This is the chart that I've been sending across on internet. This is where the highest point of the Dow Jones is. We did a Fibonacci extension downwards. We can see the incredible impact. Let me bring you the live chart right now. You can take a look. So this is the live chart. You can see the way it's so beautiful. The way it stopped there is incredible. It's incredible, TA. So you can see right here, this is the point. This is the point, and look at it. Oh my God, look at the way the market stopped and how the Dow Jones pulled back last night. So if you'd ask me, if this is going to continue, the Dow can be heading towards 32,500 area in the near term. So where we are now, we are at 33,530. So we're talking about at least 1,000-point drop over here. Now, would it be possible, or is it just going to be like one-off thingy? I'm not too sure, but definitely to me itself, I know where the resistance is. All I need to know is that where's the next potential support. And of course, we have seen many times when it gets supported, the market actually rebound. But once the market loses that, right, the selling will bring it down further. And of course, the next wave could be actually what we saw before was during the March period, that low itself. All right. So let me know in the comment box, do you agree with whatever I shared today? I wish you all the best in trading. If not, that will be all for today. This is Cal signing off. See you on the technical side. Bye-bye.